Yogesh Patil is Chief Investment Officer, Equity at LIC Mutual Fund, with his take, his perspective. Yogesh, good to have you back on the program. What has the investment team and you been doing at the fund during the course of this correction? How much cash are you on? Just give us the basics first.
Good morning, everyone. Normally we don't keep higher cash because we're getting money to invest it. But considering the market opportunities and India's long-term story, we continue to believe India is a very attractive opportunity. But its opportunities available in raw form, and a lot of things has to be done by state government and government, central government. So there will be some lag in between whenever these capex program changes. But we continue to believe India is a long-term investment growth story, followed by, again, manufacturing and consumption. And if you see the last decade, the consumption played a bigger role and lesser investment. But we, at this point of, if you see the manufacturing GV as a percentage of GDP is almost 14%, which is almost equal to commodity-driven countries like Brazil, Russia. And China is almost at 26, Korea is 24. So India need to increase gross block, and India need to spend more and focus on manufacturing to reduce imports and improve the infrastructure, so they can most of the companies in India can be compete with the global players. So this is a decadal story, and especially gross capital fiscal formation till date is roughly 93 lakh crore, and we do see a major portion from private and government capex, basically through infrastructure investment like railway, defense, and new segments like data center, EMS. All these new things will continue to drive the India story in future, and followed by consumption parallelly, because consumption is suffering because of the poor real wages growth and salaries, and lack of new job creation. So we think we are near to close to bottom at this stage, and government is also focusing on the rural. So this will again start reflecting over next 2 quarters.
Okay. All right, Yogesh. So, how is the portfolio position as we move to the budget? Would you rather look at maybe bigger positioning in capex stocks and PSU, railway, defense, or even private sector capex names? Or would you rather look at staples, which have been beaten down quite badly, if indeed there is this hope for a rural push and a rural recovery?
Thank you. Our portfolio is completely aligned to our thought process. We continue to believe investment in infrastructure will continue to rise, and followed by capex from many private and PSUs, because this is a need of our government is trying their level best, but unfortunately there would be some miscoordination between states, or maybe new segment of companies requires a different level of coordination. Like in previous cycle, we might seen a very high capex from, let's take a cement and thermal power plant or metals, but the new capex from private sector is completely different. Is more on asset turn side, like in capex from CDMO player, EMS or GCC centers are very, very different, and this will give a very similar impact of GDP compared to last 20 years. And as a house, we continue to believe capex, and our portfolio is fairly aligned with capex stories from completely driven by power sector, data centers, railways, defense, PLI schemes, and other auto sectors companies.
What about consumption theme, Yogesh? You're getting split verdict out there. Some of these high pedigree, traditionally trading at very high multiples. Growth is not coming by, and commentary is rather subdued. At times, yes, this peak pessimism provides good entry opportunity. Has it reached that level?
I don't think valuations, we need to readjust the growth, because next 4 or 5 years the growth could be very limited, because it starts with manufacturing, infrastructure, and job creation. See, the job creation would be the trigger point for India for consumption, mass consumption especially.
Okay. That's the outlook on a couple of sectors. Just back to the market, it's still some of these mid-cap IT names which have had a better earnings performance. They're the ones that are looking better, but 6% up on persistence, actually 7% now. And Oracle Financial, Coforge, these are the names that are rebounding. In the next couple of minutes, we'll also have the management of BPCL joining in.
Coforge first.
Coforge first and then BPCL. But before we get to the rest of our corporate commentary, Yogesh, on IT, I mean, it's been very, very mixed trends. Larger companies are still struggling to showcase big growth, but mid-cap names are doing a lot better. Do you like anything here? Either traditional IT, or let's expand that further. There are internet companies that have gone through a fair amount of price correction as well. Platform companies. Would you buy into the weakness?
See, definitely, we need to see the valuation and the growth prospects. As of now, if we see last 3 quarters, majority of the companies have not given any negative shock. And the commentary has been positive with a low cancellation of projects and fairly positive side on discretionary and BFSI. And after the President Trump, I think there is no major hurdle at this point of time. It's just a valuation where investors need to choose. And at the same time, AI, there are new themes in IT also, AI, but again, it is a company-specific stories. And even forget about IT, every sector is a completely different, company-specific, segment-specific. So we are very selected in IT firms, especially between large and mids. And where is a disappointment from earning, definitely we need to relook that story. And coming back to your platform, see, platform business is very, very different and very highly competitive. And at this point of time, because of the too much of noise, we are avoiding those segments.
No, I take the point. Just a few other names which are moving around that we want to highlight. Yesterday was a big mover in Jana Small Finance, right? I think it ended up about 20% higher. It's down about 3% this morning. So 424 on JSFB. Oil India is down about 2%, and there is HPCL, which is down about 2.5-3% as well at this point in time. India Mart has been, of course, up and down, but it's down 3% now. So big decline after results for India Mart. Nestle is starting about 1.7% lower. KEC is down about 3%. Very sharp fall on KEC. Recently, last week, maybe end of the week before, was at about 1250. Stocks at about 860 now, KEC. So, a fair bit has moved around. PNB Housing, we had the management with us, 2%, 2.25% lower. And unfortunately, if you look at the market breadth, if you look at the NSE advanced decline ratio, it's now 2:1 in favor of declines. It was running 1:1 for the broader market, and it was looking like, it was a little better, but not anymore. Of course, on the flip side, you've got all these, you've got Kalyan Jewelers, which is up 2% or so after the battering it's gotten. So it's coming up with very large volumes this point in time. And I mentioned the EMS names, which are all looking a little better. Maybe put up Swiggy as well, 2.7, 2.8 higher. And I can't spot Zomato, at least not on this list with volumes, but that's got some action and activity as well. Yogesh, we leave it there for now this morning. Thank you very much. Really appreciate your time here on CNBC TV 18.